So, hi all, I'm Richard Jones, Managing Director of Pilotfish, a commercial finance broker and advisor. Today's Wednesday, the 8th of April, 2020. We are entering the third week of lockdown in our fight against COVID-19. We all recognise the need for the lockdown and support its objective to save lives, but an implication of the lockdown is a massive negative impact on the economy and businesses. I'm joined today by Zuhair Mirza, co-founder and principal of Avamore Capital, to discuss the impact the lockdown is having on the lending market. Zuhair is vast experience in the banking and lending sector, and Avamore is a specialist bridging and development lender. I'm looking forward to hearing his insights. So, hello, hi Zuhair.
Hello, Richard.
Thank you for joining me.
Thank you for having me. Looking forward to talking to you about the difficult situation we're in and how we're dealing with that.
Great, and it is very difficult for all, isn't it? So we do find ourselves in really challenging times at the moment. Issues hitting both lenders and property developers, so both ends, which is quite unusual. Let's get straight in there. What's your view on the key issues that the industry is facing, the immediate short term and maybe in the medium term?
Yeah, so look, I think in the immediate short term, developers are clearly facing challenges on site. There's a practical issue in terms of trying to get labour on site, get construction projects going and progressing as originally planned. There's also potentially going to be, I think, some issues with the supplies of materials. We've seen that happening already, and I think that is likely to intensify as we have construction sites switching on and off. We're also going to have, I think, second order effects for developers as well, which is going to be in relation to exchange rates, volatility as well, which we've seen historically has sometimes caused cost overruns. So you've got that, and of course then there's the supply of materials which might be constrained. I think there's probably a second order effect further down the road as well, which will be in relation to what could be a slowdown in the housing market. So I think we've clearly seen unemployment rising. I think a lot of us are hoping that's transitory unemployment just due to the lockdown. And as soon as the economy restarts, we'll be on our way to reducing that figure again. But if we see a persisting unemployment rate, that's clearly going to impact the economy, and there's quite a strong correlation between the housing market and the economy. And I think that could have an impact in both the sales timeframe, which it takes for the developer to sell, but also it could impact pricing as well. And as we know, it's been a very competitive housing market and developer market, so developers have been operating on fairly tight margins. And I don't think this is something anyone could have priced into a development appraisal. So this is going to be have a negative impact on that. I think from a lender's perspective, we've probably got two levels of issues. We've got practical issues, and that relates to how developers are able to progress their sites, and that will ultimately have a knock-on effect on loan book performance. We've also got practical issues dealing with MSs and valuers in terms of their ability to visit sites, but also some of the constraints they're coming under from the bodies they're supervised by. And I think RICS is a classic example of that. I think those things are things which are surmountable, and I don't see them as being kind of major issues, but they are practical points which we're going to need to deal with along the way. I think the slightly harder point as a lender is pricing risk in this market. And I think what we're seeing at the moment is we're seeing markets which are heavily dislocated. Some of you will be aware of this, but we're seeing investment grade diversified portfolios trading at 4 or 6% per annum. Those are things these are bonds which previously traded at 1, 2 tops. So we've had a massive move or shock to the pricing of capital. And I think that's something which is most likely just a short-term dislocation, but it does create pressure in financial markets. And obviously we've seen the Fed reacting to that. We've seen the Bank of England reacting to that. And so it's likely that will normalise fairly soon, but there is ultimately a shock which we faced. And I think there's a second part of that, which is maybe slightly in the longer term, which is, again, coming back to the economy and unemployment. This could be a sharp and short slowdown, which we rebound from quite quickly, in which case, we think the underlying asset class, just property, will be fine. However, if we slip into a recession slowly, it's going to be incrementally harder to price that kind of risk, because particularly on the construction side. So I think those are the kind of various challenges that we're facing. And I think, I do think that often when you're kind of in the sort of the thick of the storm, which is probably what it feels like now, these things can often seem quite significant issues. But I think in time, I'm pretty sure all of these points will settle down and we'll be able to address them. And it's something which is natural for this sort of market environment. It happens every 10 or 15 years. We had it in 2008, and things did settle, and opportunities come out of it as well. And ultimately, the one thing I think we're quite fortunate about is we've got properties, a very strong underlying asset class, and we're all linked into that. And over the long term or medium term, it's always shown strong fundamentals.
Well, let me just come back on a couple of those, because that was very comprehensive what you did there and answered that. Let me just pick up on a couple of key points then that we're seeing on our side as well. Mm-hmm. Do you think you're able to move on the valuation side? You've mentioned their valuations are challenging in lockdown. We are seeing some lenders really pushing hard and moving quickly to automated valuations. Do you see that as a solution in your market and what you're looking at?
Yeah, I mean, look, I'd say it's a pretty fast-changing environment. We started off with valuations being provided. That very quickly moved to being valuations which were heavily caveated for material uncertainty, which effectively meant that lenders couldn't place the same reliance on those valuations that they would usually do. And there was effectively a transfer of risk, if you like, to lenders. Now that's moved to the fact that valuers can't even go out to sites in some cases to visit. So we've had incremental challenges. We've sort of been responding to them as we've gone. I think, it depends. I think how we approach it now depends largely on a case-by-case basis, to be honest, because when you're looking at a bridge loan, it's a fairly simple property. There may be a schedule of accommodation, which was done a year ago for the sale of the property. In that situation, you can have a valuer perform a desktop. They can look at the square footage of the property, and we can get a sense as to where we think value would have been a month ago. And then that at least creates a benchmark in the kind of as to where a starting point is. And then as a lender, you can then take a view and say, right, well, look, it's hard to know where values are today, but we can take a view on what we think a reasonable LTV is based on previous values, which at some point can't be a long way off what values will be in the future, we'd hope. I think where it becomes more challenging is when you go from that kind of simple vanilla end of the spectrum over to development finance. Or maybe sometimes somewhere in the middle, where we can work off plans which we can get from the planning portal, but when you're looking at a development scheme, often actually getting an understanding of the scheme and the comps is much more important. And I think it's a bit more challenging in that respect. And there is obviously mitigating factors to say we can look at information which is provided in a documented form. But I do think with development, it's slightly more challenging. And the other issue, of course, is when you're doing things like exit bridges, where there's been development works done and we're providing an exit facility. And I think in that situation, you do want to see that, for example, the planning drawings have been complied with, and value is a big part of doing that. When they go out and visit a site, we'll need to know there are no planning breaches. We'll need to know that it's been built to a certain spec, and that spec can move value. So I do think it's a pretty difficult situation to kind of put a blanket policy over. But I think all we can do as a lender is try and be as practical as we can. And I think for us, that is, if there is a base on which we can understand the nature of the property without visiting it, so that's square footage, spec and style, then I think it's easier to take a view on valuation. I think where there is a requirement to visit a property or understand more details about a property, then it becomes more challenging to do it remotely. And as you all know, that there is buy-to-let lenders have historically done desktop valuations for lower leverage deals, and I think that principle could also apply to us as well, which is if we're looking at a lower leverage situation, there's more margin for error. We may be more inclined to accept a remote or desktop val. But it's really hard for us to put a blanket policy on it, especially given we are a specialist lender and we look at special situations.
Sure, sure. And you deal in very close with relationships as well, rather than the call center sort of automated approach, don't you? So
Yeah,
that's helpful on the sort of new deal side. Your current customer base, your clients, your
yeah,
borrowers, the developers, they're facing problems that really aren't their fault at the moment.
yeah.
Um, how flexible can you be with people and your clients at the moment?
Yeah, I mean, look, I mean, we couldn't agree with you more. It's no one's fault, and we've got some developers who were very advanced, very close to finishing. We've got other developers who've got caught earlier in the stage where maybe it's a bit more difficult for them. I think what we have now is a black swan event, and I think we've already seen lenders coming forward to grant extensions or find ways to deal with delays or issues which may have arisen. I think that's a pretty consensus view of the market so far as I can see, and obviously we're on board with that as well. It is really important to remember that it is a relationship business, and that's why having an approach which takes that into consideration for the longer term, but also takes into account the specifics of a project and understanding that I do believe there are destinies and projects are tied as a development finance lender. Once you enter into a project, there is obviously the technical caveat where you can have different outcomes for lenders and developers, but in practice, I don't really believe in that. I believe that the project is a success or not, depending on how all parties operate together. Now, normally there's not much requirement in a stabilized market for a lender to be engaged or actively looking at projects and trying to find solutions, because things get planned out and you can follow that plan. I think when you get an exogenous shock such as this, there is a requirement for all parties to work together, and there's always going to be a natural limitation on what a lender can do when it comes to leverage, and when it comes to what can be waived in terms of fees, for example. I mean, an extension fee is a good example of something we think can be waived. But when it comes to other parts of the cost of capital, there are underlying costs of capital which are harder to deal with. But I think it just comes down to, it's really important to take a transparent, practical and supportive approach. And I think the two ingredients I see as being absolutely key is, from the lender's perspective, flexibility and taking a long-term approach to the situation and the relationships. And I think from a developer's perspective, I think showing commitment to the project, even at a time when it might be not going to plan. I think putting those two together, I would hope that we can see this period through.
Yeah, great. Okay. One last question for you then.
Cool.
Might be early days in this. We don't know what's coming. Could be, as a big or bad of the recession, we don't know what's going to happen. But what's your early prediction? So out of 2008, out of that recession, peer-to-peer lenders came, alternative lenders came to the market, including perhaps yourselves.
Yeah.
You think this is going to be a fundamental impact that's going to change the market going forward, and how?
Yeah, look, I mean, I think it's a really interesting question. It is still very early days, you say. I'm not sure I see any seismic changes back into kind of 2008. I think the rise of alternative capital was driven by banks pulling out the market. It left a big gaping hole, and it got filled by initially a small group of specialist banks and private capital, which then went on to becoming much larger institutional capital. And I think right now, a seismic change could be caused by the pulling out of institutional capital, but I don't see that happening. I think there is that dislocation in markets today, but ultimately I think institutional capital is attracted to our market because there is a very strong fundamental case for investing in it. We have property is a good long to medium term asset class. It's got good fundamentals behind it in terms of demand and a shortage of supply. And so it does create a very attractive environment to be lending in, and I think that's going to continue. Having said that, I do think this is the first time that we, with a number of players in our market, will have experienced a sharp downturn. If you go back to 2008, a lot of the players who are material participants in the market today may not have been active in the same way. And so it will be the first time we go through a cycle like this. And I think there may be some implications of that. And of course, we're already seeing pressure amongst some lenders in terms of accessing government schemes to keep businesses going. So, look, do I see any fundamental seismic changes? No. Do I see the room for things to change? Definitely. And I think the only thing which I think could cause a seismic change if institutional capital takes a lot of haircuts on debt over the next couple of months and then does actually pull out. But I don't see that happening. I think a lot of lenders are still fairly comfortably positioned from a loan book perspective. And I think markets are going to stabilise, and we're going to kind of return to where we were.
Let's hope that's true, and that's how it comes out. Zuhair, thank you very much for your time today. It's been brilliant, and I wish you well. Keep safe, and let's hope Avamore keeps on trading and doing lots more deals in the coming months.
Thanks, Richard.
Thanks, mate. Thank you.
Cheers, mate.